So, why should you be investing today? We're going to talk about that in this segment of the program, and we're going to draw a contrast between what investing is versus saving versus trading. Three very different and distinct concepts, if you will. And so I think in the midst of a pandemic with uncertain headlines and things like that, people are maybe steering away from investing, and we want to take an opportunity to sort of talk about what investing is and get some of the fundamental concepts on the table and why it's so important to make sure that you're doing actual investing as a way to accumulate wealth over time. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Coming to you on News Radio WFA FLA Orlando, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that provides you with peace of mind for the future. So I think there are three concepts that we need to sort of get on the table first in terms of what investing really is, and sort of contrast it first of all with the difference between sort of investing versus saving, and we'll throw in trading there as well. So investing and saving are two very different concepts. When you're saving money, you're putting it away in a secure fashion, using something like oftentimes a savings account or a CD, or maybe even your checking account or your money market. Savings would typically have easy access, no fluctuation. If you're doing it through a bank, there's an FDIC guarantee as well. So that's the concept behind saving. Saving is putting money away that you know you're going to need or potentially need over the course of the next 6 to 12 months. So sort of like that short-term emergency savings, those kinds of dollars would traditionally be referred to as savings. One of the things that we've talked about certainly in prior radio programs is the importance of, for example, having an emergency savings account. There's a reason it's called an emergency savings account and not an emergency investing account, because when it's an emergency, you want to know that the money is there, it's easy to access, and you can get it at any point in time. That's the notion of having a savings account. Investing, on the other hand, traditionally works out to own a slice of a business. I mean, that's the fundamental concept of what investing is. When you're an investor in a business, whether it's your own business or whether it's a big company like Microsoft, you in essence own a slice of that operation. Obviously, there's greater risk in that proposition, right? If you own your own business, there's certainly some risk of a lot more fluctuation than that, than the money that's just sitting in the bank, along with owning a slice of, say, Microsoft or Amazon or what have you. So there's definitely sort of a risk-reward trade-off, and as you introduce that element of risk, which is an element that is in investing, then that really helps to sort of distinguish it between saving. So if you think of it, the importance of having both cannot be understated, of course, because you need to have an emergency savings, and then, of course, you need to make sure that you have a larger portion that is on the investing side of the equation. And I think this is where sort of people are getting a little tripped up these days, is that oftentimes folks come in and talk with us for the first time, and what we typically see is that it almost seems like they are doing great on the saving side, but not so well on the investing side. And by that we mean that if we see the vast majority of all of their assets sitting in a fixed account or a stable value or a money market, well, then you're saving. You're not really investing. And the reality is that you should want to have some savings. Maybe that's $25,000, and depending upon where you are in terms of your total asset picture, maybe that's even upwards of $50,000. But you start getting above that, you really want to then make sure that your investing side is a factor of 8 to 10 times more than that. So if you're saving $25,000 or $50,000, your investing side should be maybe 500,000. And the investing side has got to be bigger, but in today's world, we often find that the savings piece is much, much greater than the investing piece. The other thing to consider is sort of investing is like gardening, right? If you think of it, you plant a tomato seed, right? It doesn't, the next day you don't get tomatoes, right? I mean, it takes time, it takes patience, and it takes regular attention, right? Time for that tomato to grow, time, patience in terms of making sure that it's ready to produce or on the line to getting production of actual tomatoes, and regular attention. You can't just plant it and be like, oh, okay, I'll have tomatoes in 90 days. No, you've got to water it, you've got to take care of it, you got to feed it. That's a lot like what investing is. It's not an instant gratification process, which is why we don't view, sort of all the trading stuff, to bring that concept into the mix, all the trading accounts that are getting established out there as really akin to investing. Those trading accounts where you're in and out, that's not really what investing is. Investing is about growth over time and having that patience. Think of it like that gardening analogy where you don't have tomatoes when you plant a tomato seed. You wind up having those over a period of time. And then, of course, investing also requires a concept of the economic, an understanding of the economic concept of opportunity cost. And so what opportunity cost is, if you have $1 or $100 or whatever, there's an infinite amount of possibilities that you can spend that dollar on, right? You can go food or travel, well, maybe not travel right now, but any infinite amount of options that you can spend that dollar on. College, retirement, cars, whatever the case may be. So when you spend that money on whatever it is that you spend it on, that means that you can't spend it on anything else, right? So once you've spent that money, then you've got to make another dollar in order to get the next thing. So consider how you spend money, because there's always that opportunity cost. Once you spend that dollar, you can't spend that dollar on something else. You've got to go out and make another dollar in order to have another dollar to spend money on. So those are kind of the three key concepts about investing in and of itself. There's a difference between savings versus investing. Way too many people these days are more on the saving side rather than the investing side. And then on the flip extreme, way too many people are on the trading side rather than the investing side, witness with all of these different online trading accounts that have been opened over the course of the past 12 months. And then as with anything, investing takes patience. It takes regular consistency. It takes paying attention to it, and then understand the concept of opportunity cost. So then if you kind of think of those three concepts, then we shift to sort of the other three concepts that are out there that make investing as valuable as it is. So we talked a little bit about this in talking about investing versus saving. There's the concept of risk versus return, right? Investing typically has more risk, but it has higher potential for return. Historical averages on the investing side would put you at 8 to 10%. Historical averages on the saving side might put you at 1 or 2%. So understand that that's a pretty big difference between those rates of returns over time, which gets us directly to sort of the next concept about investing and why investing is so important. That is the magic of compound return. It's been called the eighth wonder of the world. I think Dave Ramsey is one of the ones that calls it and refers it to that. But what that means is that with compound growth and compound returns over time, so you start with a certain amount of money, and at the end of the year, if it's made a certain percent, then it grows by that certain percent. And then the next year, the growth is then not on the original amount of money that you started with, but rather on the original amount of money plus the growth it made in that year. So as you can imagine, that sort of continues to compound over time, and it accelerates the growth of the investing. So the analogy would be, consider the analogy of planting that tomato seed, right? So tomato seed, plant it over a long period of time, you ultimately get tomatoes. What's in a tomato? A lot more seeds. And that's a great analogy to what the power or the potential of the magic of compound returns that ultimately happens. It takes time to realize, the effect of those compound returns, much like it takes time to grow a tomato, but then you got a tomato with a lot more seeds from that one seed that you started with. So that's a good analogy for the magic of what compound returns. And then, of course, there's multiple aspects of growth as an investor. You can have growth as dividends, through dividends. You can have growth as just straight appreciation. So those are sort of the three very unique concepts of investing, taking advantage of that risk-reward sort of trade-off, using the magic, not really magic, but it's the power of compound returns, and then getting those multiple aspects of growth. So hopefully we've given you something to kind of sort of think about in that segment, the difference between investing versus savings and some of the key concepts of why it's important to be an investor rather than be solely a saver. You need to sort of do both at the end of the day, but do investing a lot more than savings in order to accumulate wealth over time. With that, we'll take a break and come back after these messages here on Dollars and Cents.